Hello everyone, this is Bella. Welcome to the next installment of my series of instructional videos on price behavior. In the previous videos, we've looked at how to break out of a range and trade. So in today's episode we're going to learn how to trade a breakthrough or what kind of entry mode is best for us to make a breakthrough. When the price breaks a band point, or breaks a multiple validation level within the band, or breaks a slanted support resistance line, there are several types of movement and novice traders don't understand the difference between those types of movement, so they see a break, and we as price behavior traders should recognize the difference between those types of break and those types of break that we shouldn't participate in or we don't recommend participating in, such as a sharp break in a range. Let's take a look at the case of a break in this interval. Before the K line is broken by the red arrow, the market has made a pattern in this interval, and the upper edge of the interval is the resistance line, and the support line of the interval is a little bit above, and the lower edge of the interval that I'm drawing now is the last shape that we verified, 1, 2, 3, and before this arrow, there is this a few times. You can pay as long as the horizontal line to move up a little bit, but that's not the point we focus on is the breakthrough. We see this breakthrough is continuous rises from its beginning to break through the sharp price, did not pause too much. We often talk about this kind of rapid movement in the interval, and it can be an orgasm movement or a vacuum effect that tends to lead to a false breakthrough. If you look at this case, and you look at all the breaks that are marked by the arrows, it's the same rapid movement like the first arrow, the rapid movement from the top of the range to the bottom of the range without much pause before the price goes down to break out of the range. Then that movement might be selling, and the high is unsustainable and tends to lead to false breaks. And the second time it's the same thing, it comes out of this rally with a sharp downward motion and a false break. And the same thing with the upward break, it goes straight up and then it goes down and then it goes up without much of a pause, and then at the end even a very long positive line breaks up the interval, which we often talk about is probably a sign of energy exhaustion. So the one thing that both of these cases have in common between this graph and the last one is that they were running fast before they broke out of the range. It was a fast break, and the fast break is the kind of break that I would advise you to try not to trade. There are times when this rush is a real rush, and it's a real rush, and it can start a trend, but it's one of the few cases where you can go back and look at it for yourself, and the rush is a real rush. Most of it happens against the backdrop of a strong trend, and you have no problem getting in on the bandwagon for any reason. So this really breakout is due to the backdrop of a strong trend rather than this rapid movement. One of the drawbacks when we're trading this kind of sharp break is that it's very difficult to put a reasonable stop, and when we're trading, the technical support level is usually the bottom of the previous band or the price concentration, and the technical stop of this sharp break is usually very far away, and it's very difficult to get a good break-even ratio when you're trading it. So let's just look at these two cases, and let's just assume that it's a successful breakout to the upside. Where do you put your stops when you go in? So let's look at this case where you come in when you break the upper boundary, assuming it's a successful rally behind it. Where do you put your stop loss? And you see that before the breakout there was a sharp movement, a previous band point below this K line, or even the previous band point is directly here. You can only go that far, of course not. Somebody could be a little more aggressive, put the stop loss under the breakout K line, which we see is also a very far K line, and your profit/loss ratio has been squeezed very hard. Same thing with the next chart. Assuming that this break is successful and brings a new trend, where should you put your stop loss when you enter? Let's see that the adjacent band point is also in the middle or lower of the range. So you such a wide stop loss even if you break through the success. How good can you trade cost performance? Because we're doing interval breakouts, and the way you measure the target is the same multiple of the interval. We measure the upper and lower boundaries of this range, and then we move up and we move the same way. So you see that your stop loss is at best dead, and you have a 2-to-1 profit/loss ratio. That's not even close. In some of the previous videos, there was a comment on the bottom that said, when I go to trade and break out, my stop is just a little bit below the break point, which means in this case, if it breaks up to enter, then as soon as the price goes back below the upper edge of the range, I get out and I think the break is a failure, and then I'm just a very narrow stop. There's nothing wrong with the logic of this trade. But if you do this trade, you're bound to have a very low win rate, because as soon as the price breaks and there's a little pullback, you're out of the market because nobody ever said you can't retest the top line after the price breaks. The price tends to retrace the previous band point or the previous concentration, so you don't have any problem with a breakout like this one retracing the edge of the band and then going up again. I read on the internet a while ago that specialized in this kind of breakout trader is the breakout narrow loss if we're. How to participate in these slanted support resistance lines breaking. One important reason why I don't like the breakthrough of the trend line of trading is that it has multiple solutions. For example, in this case, we drew the downward trend line at 3 points, but we found that all the 3 points are shaded. It is okay for me to draw it this way, and it is okay for me to move it. So if I were to use this trend line as a breakout point, where is the price level that we're going to break? Right here, and if we're going to use this trend line as a breakout point, our breakout level is going to be right here. Which level are we going to break at? Isn't it? I personally don't like the idea of trading like this. Some people just jump in as soon as the price breaks out of this downtrend line, but when you come in like this, where should your straight start be? I would say the best technical stop is definitely below the nearest band, so if you say stop this far, let's see, that's $1,300, and then you go up here and you have a 1-to-1 break-even ratio. If you're more experienced and you're better at trading and you can put the reason why you're here is below this breakout K line. And if you're a little bit more skilled, then you can look at the price after you get in and see how it moves here, whether it's a breakout or a breakout. But I think there's a very small number of people who have access to this kind of educational skills, and most people are still going to do the simple trade that you're below the top band, and then the trade is probably not worth doing at all. If I'm going to be involved in this breakout, then I'm going to wait for it to break through a pullback and then continue to break through a pattern. The price after the breakthrough and go 3K line, the first is with a strong positive line that we have nothing to say, the second is marked. The second it is a representative of the bear power of the K line at this time we have to pay more attention to. The third is to explain second root, third root important to explain. In the second K line we see that there is a long upper shadow and there is a long short entity, and that is an indication of short power. This K line, where does it happen? Some of you may have noticed that it's happening near the top of the X band, that there's another sharp upward movement near the top of the X band. Is this a bull's high water movement? Student, can you think of it as kinetic energy depletion? Is it okay for someone to start shorting based on this K line? Alright. So let's say somebody shorted that, so let's look at the K line in the back, which is the third K line, which is the K line marked by our second arrow. After the previous short trader came in and closed a K line, indicating the strength of the bull, let's look at this K line. Has a very long bottom line and a long entity has a short upper line, so does it also demonstrate some sustained buying strength? At this point, let's take a look at the bearish and bearish forces in the market. This is when there is a pause in the rapid movement of prices. There must be contrarian participants or participants who believe that the breakout has failed. These participants are already in the market and have taken positions. What happens at this point? It's very simple that the traders who think the breakout failure here have stopped their losses, so this second breakout to the upside, is it a breakout after a pullback? You can interpret these two K lines as a breakout pullback. If you continue to break up, that's a premise you can't think of it now. Student, assuming that it breaks up, then you can say that because in the little period you can see an upward band high and then you have a low band and then you can go up and break a higher band and move up. Does that make sense to you? Suppose I was a major breakout trader and I saw the state of the market and I saw this signal. What would I do if there was an upward break from the downtrend line? After the breakout, the price fell to create a new band low. If the price breaks to the upside and I think this decline is a breakout correction, then my stop loss is below this band point, and you see this time I enter my stop loss. Logic is very clear, unlike when you break this trend line and you enter a lot of times it is vague. So here the stop loss is clear and the stop loss level. Is the stop loss space acceptable? Let's take a look at this stop loss range. More than $600, as long as the upward movement to the former band point, then I have a 1.5 profit and loss ratio, and then go up I take a 2-3 profit and loss ratio is easily. This way to break through the callback and break through this way is not more than we directly in the breakthrough of the road more conservative advantage. If you look at the subsequent trend after the K line marked by the second arrow, it goes straight to a big positive line which breaks the high of the previous K line, breaks the level of the previous band, and begins a simple and rapid rise. Then when it breaks this time we know that the K line marked by the two arrows is a breakout correction and it has a band high a band low and then a breakout in the direction of the original. Then if the person who enters this breakout his psychological feelings must be more secure than if you break this downtrend line, because you have a clear breakout pullback breakout, a confirmed pattern. Let's look at the second case. This is a 2-hour chart of the NZD/USD, and here we have a nice simple breakout triangle of convergence that moves very cleanly after the breakout to the stop range very quickly. The triangle of convergence pattern, which is also a trading band, which is a narrowing trading band. So the way you break out of your trade spreads is the same way you break out of the rest of your trade ranges, and the triangle of convergence is pretty standard because the upper and lower edges are pretty much fixed, and if you look at this downtrend line up here it's not much different no matter how you move it, and this uptrend line down here it's pretty much fixed, right? Therefore, it is very easy to trade the breakthrough of its convergence triangle. Personally, I rarely trade the breakthrough of the trend line, and I pay more attention to the former band points. For example, if there is no breakthrough behind this case, I will pay attention to these two band points. I only think about going in if the price goes up and down at the front band point and my stop loss is on the other side of the band point. For example, if it goes down and I enter then my stop loss is on the upper band point, and if it goes up and I enter then my stop loss is on the lower band point. What we're going to focus on here is this breakout, and what we've seen in this cycle is that this breakout to the downside is a big negative line, and it doesn't seem to have a pattern of this breakout pullback breakout, and if you're not directly in then the trade is dead. Well, it doesn't. This pattern of breakout pullbacks and breakout can happen in small cycles. Let's get rid of the K line at the back and let's change the time to a quarter period. So let's say it's 2 hours now, let's change it to 30 minutes. And what we see when we look at this break, we find, let's label it, let's look at this negative line, mark below, and we find this negative line, it has broken the uptrend line below this, but it has taken a long negative line, so at this level, we think this breakout is probably a failure, and then we have a small positive line behind it. But if you think back to the breakout pullback breakout we just had, he breaks out and then he goes back up and he goes back into the range, and when he breaks down again, is that a breakout pullback and breakout entry pattern? Let's see, let's label the key points. So here's the low, and here's another band high, and when it goes down and breaks this band low again, the pattern of a breakout pullback breakout is very easy to understand. So you put a breakout order down, and when the market goes down and breaks this previous extreme again, you go short and your stop is on top. You find that your stop loss is much narrower than if you went straight into that big range, big quantity triangle, and you get a much better profit/loss ratio, and you're much more comfortable in your position because you have a clear band point to defend. You can go back and look at a lot of successful breakouts, and it does this pattern of breakouts and breakouts, whether it's parallel trading bands or convergence triangles like this, or up and down trading channels, or even just a single trend line or a single band point. It can do the breakout pattern, and if you don't see the current cycle, then you go to the mini cycle, and in general we go to the quarter cycle, and you look and you can probably find the pattern, and if you can use the pattern skillfully, then you can do the breakout pattern much more easily. Let's look at the third example here. This is a 4-hour chart of the pound versus the Aussie, and we're focusing here on the price breaking through the key level. We're looking at the last attempt to rise. The attempt to break through it was a sharp move. We said sharp moves within the range tend to lead to a run out of momentum, and that happened to be a pause near the top of the range. If we look at the performance of this price break, it's a continuous long overlapping K line, and it's a narrow trading band or barbed wire. And it's better that it doesn't happen in this way when we're trading a breakout, because I haven't found a particularly good case. I think the last time I traded this kind of breakaway pressure was a long time ago, and I couldn't find the chart when I was flipping through it. So this case price stops here, and it basically represents what is a concentrated area of a price at the top of a range, and this area represents a long/short game. And if I'm a breakout trader, I'm going to talk about subjective traders, because this pattern we can be bullish and bearish, and you want to be long and you want to be short, and you trade in the same way. The only difference is where you're looking subjectively, because we're going to talk about breakout in this video. So if you're a subjective bullish trader and you see a concentrated area like this, and if the price breaks again, do you have a good defensive position? Because all you have to do is put your stop below the concentrated area. So let's say that the price continues to rise above this concentrated area, and we put a breakout order, and then our stop loss would be below the price concentrated area. And then our stop loss logic would be very clear, and we would have a well-defined defensive position. And if we were to have such a rapid breakout without such a concentrated area, then we would see that the rally does not give us a reference point to stop. We think of this price concentration at the top and bottom of the range as a breakout pressure if you are subjectively a breakout, and if you are a breakout failure, then you can think of it as a failure pressure buildup, and that pressure buildup can give you a good defensive position, and it can give you the motivation to break. What if, for example, the price breaks clearly to the upside, and traders who are short in this concentrated area stop their losses, and they stop their losses, and they leave, and that's what drives the price up. If we look at the subsequent action, we see that the next time the price breaks out of this concentrated area, it goes up, and the next time we go long, it's a strong positive line. Why is that? As we talked about, a lot of traders who are short in this concentrated area will take a stop loss on the way up, and their stop loss will drive the price up. This case of breaking the front pressure is actually not a very good one. It's better to make a small box here that has a clear upper and lower edge, but I couldn't find a standard case when I was doing the video. This pre-breakout pressure buildup can be used whether you are a breakout trader or a breakout failure trader, because it gives you a clear breakout and a clear position to stop and defend. Another example of gold: if you trade this pattern as a convergence triangle, then the last breakout is a breakout pullback breakout pattern. If we look at the first breakout to the upside, that makes a high, and then the price pulls back and makes a low, and then the price continues to break above the previous high, then it's a breakout pullback and breakout an entry pattern. That entry stop tells us that, but we can trade this pattern in other ways, because it's not just the convergence triangle, but it's also the breakout of the level. So we mark that level, and we look at the price, and it jumps up to band resistance, and then it makes a lateral adjustment, and that jumps up. If you've been through enough classes, you should know that it's not recommended to trade. If you're going to trade and you're going to get caught up in things like this, it goes up very quickly, and then it makes a lateral adjustment. And what's the shape of the lateral adjustment? And what we find is that it's a little box with a couple of K wires, and it's a mini trading band. At this point, if you've been listening to this for a long time, you know what to do. Then this mini trading band breakout can lead us to the larger form breakout, this mini home space, which is also a breakout pressure. If you're a subjective long trader, when this little trading band is formed and the price continues to break up, then you have an entry level and a clear stop loss, and then you continue to break up, and that's when we break out and go long, and then you have a clear functional level that is below this little teaching band. And when you break up, you also break out of this big one, which you can think of as a trading band, or you can think of as a convergence triangle. And someone might ask, well, isn't that what you did in the previous video for that breakthrough failure? In fact, I've been saying that when the price breaks down, whether it's a pullback or a breakout failure is completely subjective. When it's in the market, there's absolutely no way to tell why we're making money trading this pattern, whether you're a breakout failure or a breakout success, because you have a clear entry logic and you're not doing it. Number 2 is you have to have a strict stop loss. For example, if you are subjectively short here and you come in, then if the price breaks, you have to have a strict stop loss. And number 3, whether you're a breakout success or a breakout failure, the advantage of your trade is never your win ratio, it's your break-even ratio. Because what we found is that the pattern of breakout success and breakout failure are very similar in a lot of places. So it's going up and down, and it's going to be 55 breaks most of the time. So at this point, if you have a high break-even ratio, let's say a 2-to-1 break-even ratio, even if you only have a 50% chance of winning, you still have a mathematical advantage, and you do it for a long time, and you are reliably profitable. Let's look at a case after a breakout range, because not only does the price do complicated things, when it breaks out of a breakout range it can sometimes falter when it breaks out of a breakout range, and if you don't deal with that, then you're probably going to have a bad time or you're going to get swept off by mistake. We see a well-defined trading band in the front where the upper and lower edges are pretty much fixed and the lower support lines are somewhat multifaceted, and it doesn't matter how you draw them because what we're really looking at is the state of the market after the breakout. If we look at the last price, it broke out of the range very quickly, and it has already broken out of the previous low in the band by a large margin at this point, and a lot of people would consider it a breakout, but instead of immediately following the breakout it made a smaller box. Let's say the smaller box, it's a smaller trading range in a smaller time period, so at this point in time, whether the breakthrough of the interval is a success or a failure, if you have studied the course for a long time you should know that 50 to 50 means that before this little box is clearly broken up and down it is 50:50 up and down probability. So whether it is a success or a failure nobody knows, but how do you do it subjectively? So if you're a trader who thinks it's a bust, then you're going to think it's a breakout correction, and if you're a trader who thinks it's a bust failure, then you're going to think that this box is a breakout and there's no follow-through. But what is it that we don't know until this little box is broken like it's broken now? We know that this is a breakout pullback. We're going to focus in this course on the breakout. So how do you trade at this point in time when you're a breakout trader? And we say we're not going to get in during this rush, so we're not going to get in the short order here, and after the breakout, let's make a clear box. This box, the body, is pretty standard. So we're now a subjective breakout trader, and that's pretty easy. We're going to be short at the bottom of the box, draw the level, so our stop is above the box. If you're a little bit more sophisticated, that means you're a little bit more technical, you can still use the entry mode of breakout pullback and breakout in a smaller box. That means you go to a smaller time level to find that breakout or breakout, and then your stop loss might be a little bit more narrow. So how much? I'm not going to read it as a kid, and that's the logic you need to understand. As long as you are a box or any break, you can find a pattern to reduce your stop loss. If you look at this case again, it makes a smaller box when it breaks the lower edge of this interval, and whether that box breaks a callback or breaks a failure depends on your subjective opinion. What's interesting here is that we can see that there is an entry pattern of a breakout pullback and then breakout. And how do we see that? We look at this first breakout K line with a very long lower shadow and then a rising K line followed by a low and a falling K line. So there must be an entry pattern of a breakout pullback and breakout in the mini cycle, and we've also found that this pattern has stopped and it's been rejected by the market, that even though it's such a conservative pattern it still stops, and there's no way you can do it no matter how well you trade, no matter how well you form, no matter how well your system has stops, and you make mistakes, and you have to accept that, because I found that both the people who were commenting on the video and some of the novice traders in the group were very uncomfortable with the idea of a stop loss. Which is totally wrong, because you have to accept a stop loss when you're trading. If we look at this little box, if we don't get in on this steep descent, then the box is completely up to you. So let's say I'm a trader who thinks the breakout is going to happen, and I'm going to do the bottom break of this box, and even if I go a little bit more aggressive when this little box is already formed and there are so many lines up and down, and I'm going to put a short single stop on the top of this little box, and I'm going to label it, because the small box is also a trading range. The trading range can be high and low, that the small box above the empty, because I think the break is successful. So I will think that the small box will also break, that my profit and loss ratio is very high, right? Take a look, stop loss about more than 60 points, that stop profit. So if you're a trader who thinks the breakout is a failure and you hook below the range and then you put your stop a little bit further down the range, because this is a tight trading range where you're more prone to false breaks, so your profit/loss ratio is going to be very high, and that's when it turns out that if you do this form, the win ratio doesn't matter, because any way you analyze it is 50 to 50, and if you're any better you have a 60% win ratio, it's not going to be much higher, but this form is very easy to give you a high profit/loss ratio, so you have a mathematical advantage and you have to take it. One more simple case, this is the 4-hour chart of the Canadian dollar versus the Japanese yen, and there is a clear horizontal resistance, and the first time the price broke through it, it failed. We see that the breakout was followed by a sharp pullback back below the horizontal line and the decline was very deep, but then he encountered a new bid and continued to rise and break out of the front band. Is the pattern of our failure to break through his failure again? The failure of a breakout failure is a breakout pullback, and that's what I've been talking about because we don't know whether it's a breakout or a pullback until we get to the end. Or we think this point you must to think about to understand because a lot of people can't accept it. He could not accept the uncertainty of price movement. He thinks the market is only one solution, must be up to down. If he thinks that he says will increase fell, he won't accept he is thought to be empty and rise up. He also can't accept this is wrong. It's the market and it has multiple solutions. No matter what you think, no matter how smart you are, there will always be someone as smart as you who thinks the opposite. Let's look at what's going on in the back of the market and we can talk about it in the back of the market, and what we found is that after it's gone up, it's made a wedge line, which is one of the patterns that we use to do pullbacks or reversals, and it's also hit a big band level. Well, this is a very good short position, but we find that the market has negated this 3 push, wedge, and many times tested horizontal resistance, and this is a very, very good trade opportunity if we don't look at the back and take the back off. This is a very, very good short trade opportunity, but we know the back market has negated it. Recently chatting with friends and leaving comments on videos, I also found that many novice traders are unable to deal with such unexpected movements due to their imperfect knowledge system and insufficient trading experience. For example, if he learns a pullback pattern and learns a breakout pattern after entering the market, he does not follow what he has learned. So, let's say we're going to call a pullback or we're going to call a bull flag. The flag doesn't go up and then he can't take it because it's not what he learned. But what you have to be able to do as a trader to survive in the market is to be able to deal with any market movement, because there is no perfect way to trade or trading system or technical analysis in a trading market. There can be no you tell me conditions ABC. What's the deal? I get paid for my entrance. There's no such system. So you have to accept all kinds of movements in the market, but it's very difficult for a novice because the novice's knowledge system is not perfect. For example, a novice learns to invest and build managers and double managers. I always give examples because a lot of people just learn to trade and that's how they learn to reverse the pattern. Do not press together. He does not know how to do this. Can only say that you have to learn more knowledge to your whole trading system of knowledge system. Perfect no matter what kind of market movement you have to be able to deal with. Of course, there is a lazy trading law, but this lazy trading law of your mental capacity is very high. What do I mean by this lazy trader method? I learn a system that gives me the opportunity and I do it like this upward wedge and I go short and I do it and I enter and I leave it, either give me a stop or give me a stop, and it does whatever it likes in between, even if it comes out of something that I don't expect, and I don't care, and there's nothing wrong with that, but a lot of people don't do that, and he feels bad when the market doesn't go with him. And if you don't feel bad, you don't care about it and you either execute or you cut your losses, and that's perfectly okay. And if we look at our last case today, which is the 1-hour chart for gold, there's a standard trading band that I've drawn, but this break in the trading band is a little bit different than our previous cases. What we found was that before the breakout the price made a small convergence high and then it went down in turn. So it's very common for a large pattern to contain a small pattern in trading. So the inside line of this structure is that if you have two patterns that are favorable to the direction in which you're going to trade, then you're going to have a higher success rate. So let's say there's a big trading range and then there's a small convergence. So if it breaks down, then it's true that both patterns are true, and then our win rate will naturally improve. And because he's got this small convergence, we're going to do a breakout. Let's say there's a breakout pullback and breakout pattern that the market has rejected. You can look at the breakout pullback and breakout, and if you don't see that, you can go back to my original case and see when the breakout pullback and breakout. If you learn it, you should be able to see it straight away. We see that the signal is being rejected by the market, but with respect to this break in the interval we are already in, because there is a small convergence, and a small convergence, as soon as it breaks down we are in, and we stop our losses just by placing them on the front band of the small convergence. So for example, in this case, we put it here and it was very safe. And what if the market went the other way and this little convergence went up, and that stop was our entry, and there was no problem because the big picture is a trading range. So now the price is in the lower middle of the trading range and this little convergence has been chosen to break up, so let's go in and go long and put the stop down here, which is also a good trade. Okay, that's all for today's share. Recently, some of my friends went to trade after learning my course. If the market goes according to what I say and what I teach, it is very good and easy to make money. If the market goes out of the trend that has not been taught or the trend that has been preached fails, they don't know what to do and even some people are fooling around. If you learn now and don't understand the place, that is very normal. Instructions I haven't talked about, so I always emphasize that you had better in the learning stage to more than to go to the actual transaction resumption, more summary, more thinking. If you don't understand the place, to record and wait for later unified questions. Thank you for watching. Please consider like, comment and subscribe. Also don't forget to follow us so you watch the following updates as fast as the video upload. Bye.